But that's not all there is to knowing when to get into the market. I like to look at not only the industry, which is a little bit of a top-down view, and a sector, which is a top-down view of the stock, meaning that you start at a kind of a broad area and narrow yourself down to the stock. I like to look at the stock itself and whether or not it's moving in the direction I want. That's kind of a bottom-up view, so I do both. But then there is a macro versus micro view of the market. And this is where I bring in what I call my oscillator. It's my crossover oscillator. The name of the chart is the Turner Crossover Oscillator. And what it does is this. Well, I'll get into the detail of what it does in a minute, but let me ask you a question. If you knew with a fairly high degree of certainty when the next correction was going to be in the market, would you change the way you invest in the stock market? Let's just say that this afternoon someone was to say to you, it looks like within the next 2 weeks, next 3 weeks, next 4 weeks, that the market is going to severely correct and move lower. What would you do differently? Back in 2008, it was May of 2008, my crossover oscillator was saying there's going to be a correction, a pretty significant correction. Now, at that particular time, the market was on a tear moving higher. I told my clients at that time, it's time to tighten stop losses and or go to cash. Now, I don't mind telling you, there were a lot of people that thought I was an idiot, that was completely wrong, because the market was just taking off. Now, you think about what happened after May of 2008. You think about the people that you know, maybe you're one of them, that lost 30%, 40%, 60% of their life's savings that they had tied up in the market because they stayed in. What about those mutual funds that you owned? I had a gentleman call me, a client of mine call me yesterday, and he said, Mike, I can't tell you how much I appreciate what you have told me about when to get into, or more importantly, when to get out of the market. He said, I used to be in mutual funds. And he said, I have watched those managers of mutual funds ride those funds down 10, 20, 30, 40, 50%. He says, it's unconscionable. And he says, I'll never be in another mutual fund the rest of my life. Well, I'm not advocating that you do that. But I am saying that there are ways to know within a reasonably high degree of certainty whether or not you should be in the market or out of the market. So I'm going to bring up the oscillator and talk to you a little bit about that. On this chart, you're going to see basically two major lines. There's three actually up there. One has to do with the market itself, but I'm going to concentrate on the black line and the red line. That red line, and you'll notice that it moves up and down and up and down. It's kind of it's fairly cyclical. That is the number of new short sell signals coming out of my system, out of about 6,000 stocks and ETFs. That black line is what I call my composite line. And it's really nothing more than the total number of new buy signals less the total number of new short sell signals. Now, I'm going to draw circles around some very significant points of where these two lines cross. Every time that these two lines cross going up and then cross again coming back down, there is a correction that follows. See the circle here? This is May of 2008. Here's another one that was in July of 2009. Now, when these lines cross and they give a correction signal, it doesn't mean that you panic, that you go out and you start selling short, or that you believe that the world is going to come to an end. What it does mean is that you start thinking about taking profits off the table. because this is going to give you a little more of an early warning of when to make money. Remember, it's never wrong to take a profit. Now, let's just say my crossover chart gives a signal now, or 6 months from now, or whatever it may be, and let's just say that it's wrong. Inevitably, when that does happen, when it does give the signal that a correction is likely, not guaranteed, but likely, and you start taking profits off the table, you have profits to take off the table. Because inevitably the market has moved up strongly prior to that correction warning, and you've got a grand opportunity to put money in the bank. If the market continues to move up and the oscillator is wrong, it is rarely wrong, but let's just say that it is, you could always buy back in. But you've taken all of that risk off the table by booking those profits. And I have clients that come up to me all the time and thank me because of that one chart, that oscillator chart, because it has gotten them out of the market when everybody else stayed in. And it has made them, better than that, it has kept them from losing enormous sums of money. So there are ways to look at this market from a macro position all the way down to the micro at the stock itself. And you can use these tools to help you make a better decision about when to get in and when to get out of the market. The key element here is have a set of rules that you follow. Don't let your emotions guide you. Don't guess. I never guess about when to get in the market. I never guess about when to get out. I never guess about what price I need to sell at. There's never a guess. I don't sit around and wonder and worry, and I listen to what goes on TV and what the president is doing or what Russia's doing or China's doing or what the BRIC countries are doing. They don't, it's information, it's good information, but I don't let the day-to-day actions of the socioeconomic, the geopolitical events determine what I get into or get out of. I have a set of rules. These are rules that you can follow. These are rules that you can make a part of how you invest in the stock market, and you will be a better investor, a smarter investor, but more importantly, a wealthier investor if you have a good, solid set of rules to follow to invest in the stock market.